Hi everybody, welcome to the Finance This Property That podcast. My name is Dion Fernandez and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome to this episode of Finance This Property That. Special guests, well, all my guests are special, but today we've got Morgan from Creditee, accountant, tax agent, tax strategist, whatever you want to call them. You can call him whatever you want, as long as he saves you in tax. But thought I'd get him on here today to talk about some of the key pain points that my ideal clients will have when building out a portfolio, mainly around loan structures and tax implications. Now, I want to get very clear that this is just general advice. This does not take into consideration anyone's personal circumstances, right? Because everything will be different. But before we get into that, Morgan, welcome. Thank you so much for giving me your time today. Mate, how have you been? You've been keeping well?
Keeping well, mate. It's things are just kicking back off like, Christmas break never happened, no break ever happened, and we're just into it, mate.
You're into slowly ramping up into your busy, silly season, aren't you? Because we're about to hit quarter three's almost about to finish.
Yep.
In about 2-3 weeks' time. And then it's tax planning season, isn't it?
And that is actually my favourite time of the year. Is sort of, that's where the work gets done.
Yeah.
And then sort of the tax returns and the financial statements. That's the formality because we've
output.
Yeah. So this is all the strategy piece where you can really add some value. And especially around loan structuring, you talk to clients about where they want to go, what do they want to do for the year, how does that fit in with them? And so a lot of that's what I really enjoy.
Yeah.
Just sort of getting people where they need to be.
Exactly. So tell us a little bit about you, right? How long have you been in accounting for? Why did you start your own business?
Cool. So
you got a really weird name. So tell me about why. How did you come up with that name?
I actually took it from there was a client of ours who was a mortgage broker.
Yeah.
We actually really just wanted credit as just the word credit. Credit Chartered Accountants and Advisors was going to be our business name. You need a banking license to have the word credit in your company name.
Okay.
So there you go. So then we had a client of ours. I also did a fair bit of work with startups and everything else, and they just went, I just put a bit of a funny spelling on credit. And away you go. So we just whacked a T on an E in the end, and away we went. So
credit.
Yeah, so it's just credit, and that's how we've run with it for now. So we've been in business. We've done our 4th business birthday just a couple of months ago.
Happy birthday.
Thank you, mate, which is always a very important one. I always think business birthdays are very important. You've got to celebrate them and everything else. So outside of that, been an accountant for 15 years. Accounting was actually, funnily enough, a bit of a backup plan. I just did it because I was good at it at school, but even then just did it in school because I was like, that's going to be a backup plan. Always wanted to own a business, just didn't know what that looked like, and ended up owning an accounting business. Yeah. So here we are now.
I think, but what you just said about wanting to own a business, but to know, I think a lot of people, especially like myself, in the same position, and it's good to have those sort of advisors that have been through the journey as well and still going through the journey because it's a growth thing, right? So, and we work quite closely together and we've seen growth in both our businesses.
Yeah, absolutely.
So it's really key. But, I think with you, what do you love doing? Like, I know tax planning is that, but is there something that you really like doing more so than like specializing? Because for me, like I love property and loans, but my favorite part's around debt structure strategy, building out a portfolio, making the complex not complex. That's what I like doing.
Absolutely. And similar. And I think that's why we work well together, is that we try and demystify a lot of the stuff. Because in Australia, we've got, I couldn't even tell you how many pages worth of tax legislation. We've got a 1936 Income Tax Act. We've got a 1997 Income Tax Act because we got too lazy to rewrite the whole thing again. So, and then you've got GST, FBT, wine equalisation tax, then you've got state taxes like stamp duty and payroll tax and things like that. So just demystifying that for clients and being that sort of port of call for them to kind of guide them through it and just give it in a way that makes sense for them and how that impacts their business in very simple dollar terms as well. And really just helping clients get them to where they want to be. in life, because oftentimes, as a business owner, sometimes you can often be working for the business rather than having the business work for you.
Yep.
So, and we all go through those life cycles and things, but helping our clients really get that out of their businesses. And property becomes a large part of that for them. They're making money on the way through, building some good wealth behind them, and structuring that in a way that makes sense for them and gets them to where they want to be in life.
Yeah. So really helping client grow their generational wealth. Funnily enough, that's pretty much what my vision is, right?
Exactly.
Empowering financial legacies for generations. That's probably why we work so well
Yeah.
together. Jesus. So there we go. But look, I really want to get into how, one of my key players, right? And I always talk about having the team. You always need it. If you want to build something great and you want to build generational wealth, you need to have a good team behind you, especially if you want property. So finance is really important.
Yep.
But from finance, it actually needs to branch out. You need other people specializing. So we're just talking to Louise before, building, who's going to find you the property and the right property?
Yep.
You need a buyer's agent, pay for that. But more importantly, for me, around debt structure and strategy is where the accountant comes into play, because this has so many more implications, not just tax, but borrowing.
Yep.
And how do you build out the portfolio? Because there are some smart ways to do it and there are some really dumb ways to do it.
Oh, 100%. 100%.
And you can get caught out. So a couple of things I want to really talk about, right? 3 ways you can really lend money.
Yep.
Or maybe 3 or 4 ways. 3 or 4 ways you can lend money. Personal name, in a company trust, SMSF.
Yep.
They all have pros and they all have cons. So let's just break it down, right? Personal name.
Easy.
It is easy. So I guess a lot of people will buy their first property in their personal name.
100%. And it is because it's purely for simplicity's purposes. I can't remember the stats around it, but like 99% of property investors will only make their first investment property purchase.
Yep.
And that's it. They leave it at that.
Yep.
Because it's simple. It's easy to understand. It's in my name or it's in my wife's name, and we just leave it there for 20 years. Worked for mum and dad, worked for my grandparents or whatever else it might be. So I'll just hold on to whatever property down the street that I've found, hold it for 20 years. Market does all the heavy lifting for me.
Yeah.
Work done. Move on.
Yep.
So personal is the lowest barrier to entry. But again, when we look at these types of things and structuring, is we look for sort of 3 key things. 1, tax effectiveness and what that means. Asset protection and what that means for the client. Are they in a risky industry? Are they self-employed? Are they, a brain surgeon where, maybe life or death every single day, and the legalities around that, and what that looks like. And then what the next step looks like for their wealth as well. Because one thing, probably about 5 or 6 years ago, when people were purchasing in trusts, banks kind of got a little bit, not allergic to it, but they kind of died down their appetite for lending in SPVs and things like that. So some clients, when they purchased in trusts, they actually hamstrung them for 3 or 4 years. And they missed out on some opportunities and things there. So that next step as well, what we talk to clients about, becomes really important.
They went too early, basically.
100%. And then hamstrung them. Whereas sometimes buying in your own name can be simple. It doesn't necessarily hamstring you. And especially as there's chats around sort of borrowing capacity and where things sit and everything else, and where those structures fall into play and how to use them. We want to make sure that it's not just right for this move, but is it right for the second move, the third move, the 5th move? What does it look like at the 10th move? So structuring with the end in mind as well, when we talk to clients about that too, becomes really important. So we cover off on those 3 things. So we'll talk about that at a personal perspective. So what that means from a personal perspective, when we look at tax effectiveness, all depends on the gearing of the property, which I know is not, I hate the term negative gearing.
We'll talk about that later.
But it is something around how the property cash flows. Does it wipe its own face or not? Are we covering things there? Because if the property is running at a loss, that can offset your personal income from whatever other means that you've got personal income.
Right. And that's if it's an investment property, right? If it's an owner-occupied property, it just does its thing. But again, so that's really key. It's all about, well, what are your intentions with that property anyway?
Yeah.
Is it your forever home? Stats are you'll probably have your 3 properties before you find your forever home.
Yep.
And then some will still never find their forever
Exactly.
home, right? So is it important?
Yeah. And so when you're looking for your PPOR, typically would be in your own name. It makes sense. Unless you're in a really high risk industry, wherein sometimes some of that asset protection can make sense. And you go, all right, well, do we put it in another structure? But again, that tax effectiveness for individual. If it's negatively geared, it can make sense to have it in your own personal name if you're a high income earner.
Yep.
So you can offset some of that income that you're otherwise paying tax on, offset some of that with the losses that are coming in from the rental property or properties.
Yep, correct. And then, once you've established what you're doing, you can then start playing a little bit of trust. Now, there's obviously two different ways to set up a trust, right? So you can purchase in company and trust. The way I look at it from a finance point of view is if you're purchasing in a trust, make it a corporate entity, right? From my understanding, I'm not an accountant or anything, but it's more that asset protection and it removes a layer.
Yeah.
Because if you have a trust and you are Mary and John as trustee for the Mary and John Trust, it doesn't help you with lending because you're still married. Like it still shows up on your personal. It's still personally you.
Oh, and we've got a situation at the moment, literally this week, that we're working through a client of they've come to us from somewhere else and we're looking at their structure and where they sit and everything else. And we're looking at this investment trust that has a couple of properties in it.
Yeah.
I'm going, why are you the individual trustee on this? Because not only are you the person at risk, you're the director of the company that runs the business. It should be, the spouse. It should be in their name as trustee for that. But even then, why do we not have a corporate trustee in place? Because if we're going to build out the property portfolio in that, and especially not to step on your toes, but that's going to be an issue when we talk to banks around financing.
Because you want to, the whole reason why you're putting it in trust is to, and a corporate trustee or an entity, let's just call it an entity, is to preserve your borrowing capacity. Right? Because if it's washing itself, you're buying the same property over and over again, and you're just tapping in on equity. So you'll either end up running out of equity, you're more likely to end up running out of equity.
Yeah.
Then you've got to just hold, then go again.
Yep.
But it's what people don't understand. If the trustee's you individually, you might as well just buy it in your name.
Oh, and another thing as well that's often overlooked is estate planning as well. And especially being an individual trustee of your own trust that might hold a few assets and things like that can also start to become a bit of becomes an issue further down the track. So having that corporate trustee in place, so that company has to be a $2 company. Oh, $2 company is sort of the slang that we use in the accounting world. It's just a shelf company, exists on paper only. Mum and dad can be the director of it and the shareholders of it and everything else that comes along with it. It just exists on paper purely to be the trustee of that trust. And away we go. Just because it affords you some flexibility further down the line, also helps in terms of, again, relationship breakdowns and things like that, estate planning as well. Also helps, if the son or the daughter gets a dodgy boyfriend or girlfriend that you don't really quite like and you don't really want them to have access to anything as part of that. So it just becomes a really important tool outside of tax.
Yeah. I think we've got to stop thinking about that, just the tax stuff. Because I think that's what it's like, no. This is actually protecting you on a broader scale.
Oh, and when you look at it, and this is how we talk to clients about it, is that when you think about the fact that if there is a relationship breakdown or there is that sort of dodgy boyfriend or girlfriend that your son or daughter might be with, well, they could take a quarter. They could take a half if they take you to court or something like that. So it's really, and that's going to be more than whatever tax you pay.
Or the cost of running the company, the director fees that you pay every year, the ASIC fees that you pay every year. And over that long period of time, it'll be worse off.
Yeah.
But and I guess, looking at, so going back to what you said about the banks not wanting to lend for the trust, look, they will do it. You just got to structure it correctly, right? If it's not structured correctly, that's when they won't lend. Now, what they usually like to see is there a beneficial interest? Because if it's husband and wife and you want to use the wife's income, or it's just the husband's the director and the wife's not a beneficiary, well, why are we using her income? There's no beneficial interest, technically, in the bank side. Even though the trust technically could be set up that way, her name's not there, therefore can't use it.
Yeah.
So,
and that's where that structuring piece, when you get into the nitty gritty of it, it's got to be right. You've got to set it up right the first time. Because again, when we go back to that client that we've just onboarded and are walking through their structure now, they've had a few trustee changes. And we're going to actually implement one that'll be the final one forever and always. There's been a few changes on the beneficiary front as well. And all those types of things are a headache for finance.
Yep. Well, I even just had my trust structure changed. Because, obviously you know that. But because I didn't realise that it didn't extend to, it didn't extend past myself and Charlotte.
Yeah.
But I'm like,
And you don't necessarily have to, we might never do that. from that side of things.
No, but it's there.
But we want the option.
Yeah.
We might want the option to distribute to your related entities.
Yeah.
Or we might get further down the track 20 years from now and Charlotte might be running her own business.
Yeah.
And you might want to make whatever her business or company, whatever structure she might have, a beneficiary of your trust.
Correct.
So we want to be able to give ourselves the option. So the way in which we draft our deeds and things casts out, and also it's the 21st century at the end of the day. So blended families exist and different types of relationships exist as well. So we cast out a wide net to give people the option.
Yeah.
Will you ever do it? Maybe not,
Yeah.
but it gives us the option of doing so. And that's the important thing.
Yeah, because I said, I'm like, that trust's not even doing anything.
Yeah.
But I said, but then it's got the option to maybe do something down the track. So, which is great. The other thing it's probably something just come up recently, and whether you can answer this or not, that's completely, just let me know. But when the corporate trustees company, right?
Yep.
There's certain banks that require the beneficial shareholder, the shares to be beneficially held by an individual.
Mm-hmm.
But then I get a bit of conjecture from certain accountants, not yourself, because you just do what's right for the client, saying, oh no, we need to have it as a trust for asset protection. I'm like, well, they can't, then that reduces the amount of lenders we can go to.
Yeah.
So you're robbing Peter to pay Paul. At the end of the day, we need to get this. So what? Because some of them have actually changed it post purchasing a property. I'm like, well, are there going to be CGT gains? Is it going to create a CGT issue? Things like that. So that's what you got to speak to. But what is the difference between why would you not? Yeah, the individual beneficially held versus the.
So again, it comes back to asset protection, and sometimes you can almost do yourself to death from an asset protection perspective. You got to be holistic and you got to be realistic when it comes to this. If you've got mum and dad and they're both brain surgeons, or they're doing some type of high risk activity all day, every day, well, that's when you go, well, asset protection's probably up there in terms of things, because if something is to wipe us out, it's going to wipe us out. Kind of thing. Hopefully insurance covers us, but let's just say there's a chance we might be negligent about something. You never know what might happen. So let's get things structured properly from that side of things. If it's, again, a business owner, and let's just pick on a creative agency for argument's sake, there's relatively low risk and liability when it comes to that. So you'd say, well, you might as well have it in either mum's name or dad's name, depending on who the lower risk person is. Because when we talk around structuring as well, we talk about who's our risk person and who's our asset person. And that asset person will tend to be the shareholder of those trustee companies.
Yeah.
Sometimes you'll implement a trust that's sort of like getting into your like A++, almost bulletproofing type structuring. But sometimes you don't always need that. It's horses for courses and where things fit in. But also sometimes if the trustee company's just been established, well, we might just take the path of least resistance to get the property sorted and potentially change it further down the track, as long as it doesn't muck things up with the bank.
Because I always say to get it right the first time. This is where I like to have conversations with the accountant and go, hey, mate, this is actually why I need it done this way, because you can get, if we do it with this bank, this is how they need it structured. If you don't want to structure it, we've got to go here, and it's almost like 25 basis points to 30 basis points more. I go, that's not effective. Like, for me to do my job effectively and for us to build this out, let's just work together. Most of them, once you explain it, they have no issues with doing it. I actually had one client change it, and he's already got the properties in there. I'm like, I'm not telling you to change it, but if we want to go here, we got to change it.
Yeah.
So maybe just have a conversation with your accountant.
That's the important part of having a team behind you, isn't it? Like having a good mortgage broker, good buyer's agent, good accountant, good solicitor that can handle the conveyancing and everything else that comes along with it. I'm sure I'm missing a few people off that list that you need.
Oh, yeah, and good insurance.
Good insurer, absolutely. Good insurance broker from that side of things. Good quantity surveyor to help you with your depreciation schedules and things like that. Just having that good team around you, because, again, I'm not going to pretend to be a mortgage broker. I can be dangerous enough to know where I'm getting dangerous in the mortgage broking world. Yeah. Likewise, what you can do for accounting, because we kind of venture into each other's fields.
Yeah.
But again, I wouldn't know the first thing around conveyancing. So it's important to have a good team around you that can help.
Yeah, I mean, like, I learn something every day from my conveyancing partners, right, and which I can use.
Yeah.
So things like signing the contract correctly.
Yeah.
In the right entity
that
you're purchasing. Yeah. Just really quickly, how long does it, on average, if you had to set up a company in a trust, how long should it take?
Anywhere between sort of 24 to 48 hours. So how we work is, as long as we had a signed engagement from our client, and as long as they're paid as part of, like we're paid as part of the engagement, and as long as the company name is available, we can get it turned around about 24 to 48 hours.
Yeah, I just had one of my clients take like 7 days. Actually, more than 7 days. I couldn't even submit the application.
Yeah.
I'm like, it shouldn't take that long. 24 to 48 hours. I don't. Yeah.
And it can happen relatively quickly. Now, we are dealing with ASIC when we're setting up a company sometimes, and no knock against government bodies. Sometimes, there's issues that might happen or things like that. So it doesn't always happen like that. But we at least keep our clients in the loop. Sometimes things need a manual review, potentially. The old classic is sometimes clients will use their business name and then call their company business name number 1 property or whatever. And ASIC might need a manual review of that just to make sure that the right people are registering the right stuff.
Yeah.
But again, 24 to 48 hours.
In general.
Yeah.
Yeah. Yeah. And then if there's more, that'll just be a little bit quicker.
Yeah.
Yeah. Cool. So, individual, moving to your corporate trustee. So it's important that we get the advice that's set up correctly and set up swiftly before you sign contracts, because you don't want to sign contracts in a wrong property. Then we move into SMSF.
Yep.
Right. So self-managed super fund. I think it's a great opportunity for some clients.
Yes.
Right. It's not for every client, but this is a completely another layer of technicality.
Yeah.
As well, because there's more rules.
Yes.
Right. This is non-recourse lending.
Yep.
Right. It's got to be set up in a way where there's no blowback on the SMSF.
Yep.
Right. So, again, when we set up the self-managed super fund, I know a lot of accountants say, hey, we're not advisors. Please go get the advice.
Yeah.
I think that's really important, right? And if someone refuses to get the advice, sign a document saying you refuse to get advice, right? And then I can help you.
Because there is a part of someone's own free will that if they want to set up a self-managed super fund, like there's online providers that, again, people jump onto.
Yeah.
They set them up for dirt cheap. Now, it's not necessarily the right way to go about doing things. You want to, well, at least in the way that we do business, you want to see the person that you can talk to about it, or at least have a phone number that you can call and talk to them about it, because there are inevitably hiccups in that setup process, whether it's setting up a bank account, whether it's doing the rollover of your existing super into that new self-managed super fund bank account, whether it's then setting up a bear trust and the corporate trustee for that bear trust to purchase the property, which again, we'll probably get into in a couple of steps. But just around, and then on top of that, getting the right purchasing entity on that contract in the self-managed super fund, because different states have different rules around it and what they accept and everything else. So a good conveyancer in your corner is paramount in that, because again, there's a risk of paying double stamp duty if it's not in the right name, and getting them set up at the right times and the dates around that and the signing dates on your contracts and things.
Especially, because you just touched on Bear Trust there, right? Because the SMSF just holds the cash assets. The SMSF holds the debt, but it doesn't hold the property.
Yeah.
Right, and this is what people don't realise. So, yes, the SMSF essentially is you're borrowing in a trust. But the time it takes, this is why you need the right setup. You're just talking about the right account, the right structure, the rollovers. Now, some rollovers can take 6 to 8 weeks. Some can take 12.
I had an absolute shocker. There was a client that had a very niche, they were in a very niche super fund product. It was by a big provider, but very niche, and someone had to buy in for you to get out.
Oh.
So that took 12 weeks for someone else to buy in for them to get out. Meanwhile, they had a property just kind of scoot on by and leave that opportunity behind them. So they're now back searching again. But it's really important to get those ducks in a row for those types of things. So getting it established, getting the bank account set up, rolling the funds over, and also whether or not rolling the right amount of funds. Is it 100%?
Yeah.
Should you leave some behind for insurance purposes or things like that?
Exactly. And that's where the financial advisors, like, you can't advise on that. Like, that's not your job. You're on structure and tax.
Yeah.
That's it.
And then a good financial planner can come in and go, all right, well, this is where it fits in. And a good financial planner that isn't necessarily allergic to property as well. And they go, cool, Dion, this is where we can fit your insurance in. We can write new policies and everything else. Or they go, hey, Dion, this policy is a great policy. We're not going to get that anywhere else. Leave a little bit of money behind in your super so that can just hold the policy going forward, or whatever else it might be. So having a good financial planner in your corner really helps. But that process of a self-managed super fund can take a couple of weeks to get established and have the cash in the account ready to rock and roll.
And then you need to set the Bear Trust up to purchase, like to have on the property.
Yeah.
Right? So that's really key, because that holds the asset.
Yeah, effectively. It really only exists on paper.
Yeah.
The self-managed super fund still prepares everything as if it owned the asset, but it just exists on paper purely. And again, for limited recourse borrowing.
Yes,
effectively.
that's the only reason why it's
Yeah.
there. But again, that's not set up correctly. That causes issues.
Absolutely.
And to do SMSF, self-managed super fund lending, you used to be able to have individual trustees. You cannot, do not have individual trustees.
Yeah.
Because again, it just goes back to what we were saying in the it doesn't. There's no. Oh, what do you call it? There's no firewall up. Basically,
yeah, there's really no wall of separation is what we talk to clients about, is sort of, and again, when you go back to estate planning and even just good administration, like we don't set up a fund without a corporate trustee because, dad could pass away eventually. And if that happened, then you'd have to lop his name off any titles. You'd have to lop his name off on any share registries and things like that, which administratively is an absolute nightmare. Like you've just lost your partner. The last thing you want to do, the last thing you want to do is spend 4 hours on the phone to computer share saying, hey, my husband passed away and I need to be able to change all of this. And then you get a whole bunch of paperwork off the back of that.
Paperwork.
Yeah.
Yeah.
Whereas if you just have that corporate trustee in place, the corporate trustee never dies. The corporate trustee never gets divorced. Nothing ever happens to it in terms of life events and things like that. So it just exists forever. For as long as that ASIC fee is being paid once a year, it exists. So it's really easy administratively.
Yeah.
Also can really help from an estate planning perspective as well, and could be a pretty useful tool as to how that works as well, which again, get an estate planner on the podcast, mate, and they'll walk through the specifics of that. But it can be a really important piece as well that we talk to clients about.
Yeah, and if you set it up correctly, it can work for you, right? And then you go back to the lending for the self-managed super fund. It's lent under self-managed super fund, rental plus the contributions, the super guarantee contributions. And again, how you do that, how much you put in, especially if you're self-employed.
Yeah.
Can work really well. And the only time you can actually ever use the property use an SMSF property for your own purposes is when you're a business and you're buying a commercial property to work in it. One of the biggest I have this conversation all the time. You cannot buy an residential owner-occupied property in your super fund.
Yeah.
Gone. Like you will get raked over the coals. Must be an investment.
Yep.
You can buy a commercial property and you or your business then rents it out from the super fund. And if you're still running.
At an arm's length and everything else has got to be on commercial terms, market rate, everything else.
Correct. And you need someone managing the property, all that sort of stuff. So you have that arm's length. But then you can do some other cool stuff with an SMSF as well, right? So and the other key thing, right, with the limiting, because it's limited recourse lending, it also limits on what you can do. You cannot take equity out of an SMSF property to go purchase another. It's not like if it's outside of SMSF, no worries, we can do that any day of the week. But inside of SMSF, it's to protect.
Yeah. And the other key thing that we talk to clients about as well is, it's funny, sort of 4 years ago, we were shutting down more self-managed super funds than we were opening up. Whereas now it's sort of come back in to be a bit of a flavour again. Yeah. People are sort of exploring that a bit more as super balances have gone up a bit and they're looking at things, and especially Southeast Queensland, Brisbane, the Olympics, everything else that comes along with it. People are exploring opportunities around it. But one thing that we talk to clients about is this isn't like preparing your individual tax return. This isn't like preparing your business tax return or anything else like that. Not a trust, not a company, nothing like that. This is a self-managed super fund. So we prepare everything, but we need to cross T's, dot I's, because then we flick that out to a third-party auditor. And they make sure that we've crossed T's and dot I's. And if something's not crossed or something's not dotted, they will ask questions. If we don't have the right answers, which we always do, we make sure we have the answers prior to even giving it to an auditor, but they can send back a qualified audit report, or they can send back whatever else it might be to say, we're flagging this as an issue. Sometimes issues happen and you need to rectify them accordingly.
Yeah, we're all human.
Exactly.
Yeah.
And, sometimes clients will accidentally take something out of their super fund and accidentally pay a bill with it.
Or do their own renovations on the super fund. Don't want
Which is a big no-no.
Yeah, please don't do that. Yes. Just get it independently done.
Exactly. So it's one of those things that you've got to, we talk to clients about that it is self-managed. We're here to help clients. A good mortgage broker is here to help clients. A good financial planner is here to help their clients, but it's in the title. It is self-managed. It falls on them. It's not like Australian Super where if something goes wrong, it's on Australian Super. This is on the client.
Yeah, correct. And I think the one of the other things as well, when it is self-managed, you get a bit complacent.
Yeah.
I know a few clients that I've been dealing with self-managed super funds, with property in self-managed super funds, with certain major banks that are sitting on 10 to 12%.
Yeah, wow.
I'm telling you right now, the banks aren't repricing self-managed super funds. They want them off their books.
Yeah.
I've been able to save clients 3 to 4% easy.
Which is huge.
Well, when you're thinking about the cash flow that's going to produce over a period of time, and this very, very simple refinances, and it's literally what's the income, what's the balance, what's the current rate, what's the new rate, what's the loan term. If it goes green, green, green at the bottom,
Boom, boom, boom.
done. Just need obviously documents to back that up. As long as it's been for more than 12 months or 12 months or more, I can do a very, very fast, simple refinance.
And the difference that can make to someone's wealth compounding over time is huge.
Why would you be paying 12% when you could pay
Yeah.
like in the sevens? I know it sounds really high, right? 7, 8%. But if you're paying 12% and you're going down 4%,
That's a win.
big win.
Huge.
Right? That's cash flow. Then that 4% can be reallocated to further investment. So not a financial planner, just someone that's practical about it, right? You can reallocate those resources.
Yeah, absolutely. And it's, again, we are the sort of, as the accountant, we will see that every year or even every quarter, because some self-managed super funds, if they hold commercial properties, will need to lodge BASs and remit the GST and things like that. So we're at the forefront of it, even more so than the client to some degree. So we will see those loans, we will see where things go, and we'll go, oh, Dion, you are paying 12%. You've been with, let's just pick on CBA because it's nice to pick on CBA. You've been paying 12% to them for the last 5 years. What's happening here? Oh, no one ever brought it up. I just kind of thought that's what it was, and I paid it, and away we went. Yeah, well, let's get you refinanced. Let's talk to Dion. Let's talk to a mortgage broker, whoever else it might be, to get that sorted, because it just makes such a huge difference.
What does? And you're building out a portfolio. You want different vehicles running at different speeds.
Yeah.
Right. So that's what we're looking at. But, that sort of, well, that covers off our structures, right? That's a very big, it's a very important part. And, I'm sure you get this because I get it and it drives me bananas. I want to negatively gear my property or want to positively gear my property.
Yep. If it was that easy.
What's the strategy? Like, I don't feel that that's a strategy.
No.
It's a byproduct of what the market's currently doing right now.
Yeah.
That's how I feel.
And there's a piece to it as well, is like the asset. That's what matters most in this. If it's negatively geared, if it's positively geared, does it present a good opportunity? Does it fit into where I want to go and what I want to go do and in the grand scheme of that? That's the important piece. If it's negatively geared and it still fits in, awesome. Keep going.
Yeah.
If it's negatively geared or positively geared and still fits in, awesome.
Yeah.
If it's in a trust or in a company or in whatever structure we pick, great, awesome. We'll keep moving.
Yeah.
But is the asset a good asset?
Yeah.
And again, not a financial planner or a buyer's agent, but that's the first question to ask.
Is the asset performing?
Yeah.
Yep. And because, ultimately, when rates were at 2%, was anyone negatively geared?
Yeah.
Like,
you'd be pretty hard pressed.
you can't say that was your strategy.
You've done the old 105% loan on it.
Yeah.
Finance the stamp duty and everything else.
And you're still coming out ahead.
Yeah.
Awesome. But then and then when at the peak of our rates, no one's it's not positively geared. It is going to be negatively geared. That's just the byproduct of where you're with the current market and market trends. It is about the asset. But when you think about how much growth is in the asset, it's going to sound weird. And it makes sense in my head. You may be negatively geared here, but your growth has actually made you kind of neutral.
And that's the trade-off. And that's what you want it to be. And again, not a financial plan or anything else, but when I look at this personally, when we look at buying properties for ourselves, is we're going, well, it might be negatively geared by 10 grand.
Yeah.
Just for pulling a number out of anywhere.
Yeah.
Are we getting 30 or 40 grand back in capital growth?
Yeah.
It's a very simple, 40 grand is more than 10.
Yeah. 40 grand, lost 10, I'm up 30.
Yeah. I do that every day of the week.
Yep. And I'm doing that compounding every year.
Cool.
Yeah.
The interest will stay relatively-ish the same. The loan will at least stay the same. I might pay a little bit of principal off it or something else like that.
When it's time to pay it off.
Exactly. If it fits in as to where we want to go and what we want to do, and then you go, all right, well, I'm just compounding on top of that, and that makes sense.
Yeah.
If I'm forever negatively gearing it and there's no end in sight. The property hasn't moved in value.
And then it's moving backwards in
Yeah.
value, right? That's when you got to be.
You've got a bit of a dog of a property, time to offload.
Yeah, exactly. Then time to actually speak to someone about it.
Yeah.
And understand it. And that really, I've had a lot of conversation with clients, especially buying apartments in certain cities, that when they bought it, it was a really good deal, but
Yeah.
now it's like vacancy rates are so bad.
And it's one of those,
rent them.
you have the old off the plan type situation, and some people jump on that as an investment.
And that can work.
That can work, absolutely.
Can work, yep, for a really big capital growth injection. But it's got to be the right asset in the right area.
And for the right person at the right point in their lives
Yeah.
as well. Because massively gearing up at 60 probably isn't the right move.
Bit
And
late.
yeah. Like, you can't be taking on all that risk at that age.
And banks know that.
Yeah.
Banks sort of go, oh, God, I want to lend you money.
Yeah.
Yep. You know, like with the off the plan, my partner Jana, she purchased really well. You know, property in West End. I think she was in on like 1.2, valued in at 1.35. So she'd already made 150 before moving in. 12 months later, they're selling apartments in there for 1.82 mil. Similar. So, you know, but different situation.
Yeah.
Sold property, got the equity, just parked it, and then pretty much paid cash for the property, but still has debt. But
Yeah.
you know, that's when it worked. That's something but we've seen it when it doesn't
Yeah.
work. It's really bad.
Absolutely. And it's just around making sure those things fit. Can you cash flow it? Can you afford it? Because sometimes, you know, that, especially when rates went from 2 to 3 to 4 to 5 to 6, some people struggled and they couldn't afford it.
Yeah, and who's giving you the advice?
Yeah.
Ultimately, at the end of the day, who's on your team?
And that's a really key question, because you might be at the barbecue and you're talking to someone, oh yeah, our investment property do this, oh, I just negatively gear it. And they call us for, especially for you know, quite some time, if you Googled buying a property in a trust, we were there within the top few results. So we're getting a fair few discovery calls and talking about it. People go, oh, well, you know, I can get the benefit of negative gearing through a trust. There's no benefit, mate. It gets trapped in the trust until it makes a profit.
Yeah.
So we really got to, like, if you're cash flowing it, you're cash flowing it.
Yeah.
Like, that's out of your back pocket. And that's in your after-tax dollars, not pre-tax dollars, after tax. So you might be losing 45, 47 cents in the dollar and then servicing the trust loan in there. So there's, again, a few key things around that gearing piece that then flows into the structuring piece as to how we flow it on through.
And I think that's really important to have that conversation to understand what is your goal?
Yeah.
Because ultimately that's going to drive the conversation, drive the structures, drive the finance strategy, drive the tax strategy, and drive the property buying strategy at the same time.
100%.
So, and not doing this conversation when you're about to sign a contract.
Yeah.
You know, Natalie from JHK Legal, you know, she was my first guest on the podcast. It's still on. It's really, really bad. It was done on an iPhone. But, you know, again, her biggest thing is, well, get in early.
Yeah.
How can I help? Like, it's harder for us to give you advice when you're already in the process.
Yeah.
And then we can already see the mistakes made.
Yeah.
Let's get in early.
Oh, hey, Dion, I've set up a trust. My accountant did it for me. I've got a 14-day finance clause. Can you help me out here? And you're already, you know, a standing start 100 metres back. So just having that team in place, having the right people in your corner and doing that is imperative. Having that chat beforehand, because we probably talked more clients out of buying a property in a trust, because for them, it was their first property investment journey.
Yep.
And you go, mate, that's probably not right for you, just based on their circumstances and where that's at. For some clients, it actually did make sense. So we walked through that. Is it tax effective? Does it provide us some asset protection? What happens for their next few steps for their wealth building? And you go, okay, well, the trust tick, 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 tick. Makes sense.
And ultimately, they want more than 3 properties, right?
Yeah.
And we want to protect their borrowing power.
Yeah.
That's how we do it.
And especially land tax considerations as well.
That's another big thing.
Yeah.
Yeah.
So that's state by state and where that sits in a client's portfolio as well. So especially something to consider if someone's, you know, heavy in one state or heavy in another state, and where that sits for land tax and everything else, another consideration to make, because every state is different in terms of land.
And you want to have that conversation early.
Yeah.
You don't want to have it when they're 5 deep.
Yeah.
Like,
and I've bought all of my properties in Southeast Queensland, for argument's sake.
Yeah.
You're almost sure as
paying
hell.
land tax.
Yeah.
Yeah, I think that's one of the reasons why a lot of investors have pulled out of Victoria, because you get smashed with land tax.
Yeah.
So it's not even, it's like land tax. One of my clients pays like 10 grand a year.
Yeah.
I'm like,
And it just is what it is. And if that fits their strategy and what they're doing, and some clients do land bank and they're paying land tax accordingly and everything else, because it makes sense to their strategy and what they're doing.
Because also then you go back to, I'm paying land tax, but this property's appreciating more than what I'm paying.
100%.
So you just got to look at the numbers and run the numbers.
Yeah.
I can see why people don't, can be put off by it.
Yeah.
But at the end of the day, we've had this conversation. To be honest, if you're paying tax, you're making money or you're buying an asset.
It is as simple as that.
Don't complain to me that you can't afford property, or your financials are rubbish.
Yeah.
Because you're either making money or you're avoiding, or you're spending money. You're making money or you're spending money.
Yeah.
And if you're spending money, right, how do you want a bank to give you money?
Yeah. And that's where tax planning comes into play with our clients and how we talk to them about it. Because part of our checklist that we run through with them, what kind of year are we looking at next year, guys? What are we looking at doing? Is it a borrowing year? Or are we heavily investing in our business to go again? Maybe we're hiring 3 new team members. Maybe we're buying out a competitor or something like that. What are we doing? What's the plan? How do we want these numbers to look? Because understandably, if you're paying more tax, the bank likes that because you've got more serviceability, you've got more profit falling out the bottom of your business. Sure, we'll cut you that check for 1.2 mil to buy another investment property.
Exactly.
And sometimes people get caught up and going, but I don't want to pay 200 grand's worth of tax. Well, the 200 grand allows you to borrow 1.2.
Exactly.
I can make it disappear and you can borrow nothing.
Yeah. Or we just do alt doc and then you have to pay a higher premium. But I had a client, he hadn't done his tax return since 2021.
Yeah, okay.
And I'm like, whoa, mate, I'm going to need an explanation for that.
Yeah.
There was a good explanation. There's actually a legitimate explanation. But then you can't complain to me that you're paying 8% when you haven't paid, let's call it at worst, 27 cents to the dollar for the last 4 years. Do you reckon 27 cents to the dollar for the last 4 years is going to be more than paying 8% and you get the property?
Yeah. And it's just around building that into how clients think about it. It's just, sure, we're here to minimise your tax without doing anything dodgy or unethical or against the law. We're here to help. But also if that then means that, that might hamstring you for borrowing capacity, well, let's reset the strategy. What do we need to do here? Is it something that there's a bit of a story? Have we had a big 23 and a low 24? Because we've reinvested to go back again or something like that. And that's, again, where a good mortgage broker like yourself can come into the play because the banks that might take the average of the last 2 years or if there's a bit of a story behind the 24s or how that gets regarded in the grander scheme of things. What picture does that paint for a bank? And that's really important. That's why that tax planning piece for our clients is really critical because we can find out what they're thinking of doing, what's on their mind. Are they thinking of doing those, buying again? Buying another investment property. Where does that sit? Do we need to have the profits look good? Do we need to pull back from any sort of investment in the business because we're going to be pulling out some profits and using that as a deposit or whatever else?
So do you think that's one of the mistakes that one of the top mistakes that people make is not planning? Yeah, I agree.
It sounds good to have the freedom to go, I'm going to buy a property today. Buying the right property, that's the key piece. You can go out and buy whatever property you like. But is it a good property? Can you finance that properly and appropriately? Where does that fit in? Is it your first step? Are you sophisticated? Are you not?
Who's giving you the advice?
Exactly. Is it your mate? Is it your mum? Is it your dad? Is it, someone that you've just met?
Yeah.
What's their benefit in talking to you about this as well sometimes? Because it's, not everyone has their client's best interests in mind as well. Sometimes you can just gear them up and never talk to them again. See you later.
Yeah.
But again, just where that fits in for them and going, where do you want to go? What's the plan next year? What are we doing? Cool. Well, the business has made a $500,000 profit.
Yep.
You're going to pay 125 grand's worth of tax.
Have you provision for that?
And again, that's part of the tax planning process is going, all right, well, we've got this here. That's typically due on the 15th of May the following year. How do we cash flow that? Do we have the cash set aside and everything else and where that sits?
Yeah, 15th of May, that's coming up.
Yeah.
Damn it. Yeah. What other mistakes do you see people make around investing?
Yeah. The big thing that catches a lot of established investors out is actually the quality of a good quantity surveyor's report or a depreciation schedule. It is amazing at how many clients come to us and we go, again, we are very methodical in the way in which we work, and we go, there's no quantity surveyors report. There's no depreciation schedule.
Depreciation schedule over 30, 40 years.
Oh, well, the property's 20 years old and it's not worth it. I got told it wasn't worth it. And, someone quoted me $600 to do it and I didn't think it was worth it. Oh, okay. Well, you've done some renovations since then. You've done or XYZ or, the property was only 25 years old or whatever it was, at the time. Let's at least just have a look.
Yeah.
Can I swear on this?
Yeah, you can swear on this.
Yeah. For shits and giggles.
Yeah.
Let's have a bit of a look.
Yeah.
And explore that. And again, having, we've got a good partner from that side of things that they do it free of charge. They'll let us know whether or not it's worthwhile to proceed with. They'll say yes or no, 123 Smith Street is not a goer. And we go back to the client. We say, hey, you're absolutely spot on. It's not a goer. It's a 70-year-old worker's cottage that no one's ever touched since.
We've done the sense check and ticked the box.
Yeah.
Yeah.
So we know that it's not worth it. Whereas we had one client, they bought a property 20 years ago and they just didn't do it. They just thought it wasn't worth it. We've spoken to our guys that we use on that front and they've gone, yeah, it's worthwhile. They'll probably be able to claim about $2,500 worth of depreciation on the property this year alone. And you go, the client's owned that property for 20 years.
Yeah.
That's 19 years without claiming any depreciation on it that would have made a huge difference.
Can you go back? Can you retrospectively do it?
The furthest we can go back is 2 years.
Yeah. Fair enough.
And even then it depends on timing of everything
true.
and why we're doing it. But again, having a good accountant in your corner or having the right people in your corner that can cover off on those things is imperative, because when you think about it, it ended up being the best part of about 45, almost $50,000 that client missed out on. And it's amazing how often that happens. Even in self-managed super fund land, we pick up clients that don't have that depreciation schedule. Sometimes it's a new build, owner-occupied, industrial warehouse. But still the bricks and sticks and the fixtures and the fittings all get depreciated.
Stuff.
Yeah. That eventually you will have to replace.
Yeah.
And even things like, units or commercial units or things like that, where you've got common areas and things like that, you have access to those. You're paying body corporate for those. They depreciate accordingly.
Yeah.
So it's important for those types of things as well when they get considered in a good quantity surveyor's report, factoring that in. Just because it's old doesn't mean you shouldn't at least explore it.
Yeah. Have a conversation.
Yeah.
It's basically what I tell everyone. Just have a conversation, whether you do something or not.
Yeah.
That's your choice.
And if it's a 15-minute phone call and potentially $400, $500, $600, which is tax deductible, so even then you're not losing that whole benefit behind it, we can go to sleep at night going, all right, well, we've unturned all the stones. We know there's nothing lying underneath it. We'll keep moving.
That's all we can ask.
Yeah.
Do your job.
Yeah.
Yeah. Well, mate, we've covered off a lot today. So
Barely scratched the surface.
yeah, there's a lot. So look, that's just one of the key things that keep popping up in my in the type of clients that I see, and I'm sure that there's probably other clients that haven't even asked the question.
Yeah.
Right. But that's what I'm here for, is like, well, I'll ask the question for you.
Yeah.
But if anyone had actually got any sort of information or learned something from this, just share it with your network. Doesn't cost you anything. If you want to, like I said, it's all general advice. It doesn't take into consideration your current circumstances. But if you want to talk to Morgan about any sort of accounting, tax planning, borrowing strategy, structural strategy for potential purchases, how do we find you?
Mate, 15-minute discovery call, that's on us,
Yep.
just to find out a few things about our clients or potential clients and how we can assist and work together.
Yep.
Book that in through the website. So that's credit, creditee.com.au. And there's a big button that just says chat now, book now, book in a time that suits you. They've got us for 15 minutes. They'll talk to me personally.
Yep.
We'll talk about their portfolio, where they sit, how we can take things from there. And that's how we can help.
Yep, easy. And are you on social media?
Instagram, Twitter, not Twitter, X now, everything else.
What's your Instagram handle?
So there's me personally, so it's just Morgan Patrick Wilson at Instagram, and then credit is CREDITTE _AU.
Yep.
And then same thing again for LinkedIn is just credit, Facebook is just credit, and I think X/Twitter is also just credit as well.
And then you're also on LinkedIn
Yeah.
yourself. Yep, awesome. Again, doesn't cost you anything to follow a small business. It's free. I think there's a lot of information and resources on those websites and through the certain social media places. Follow me on at Dion Finance Specialist on Instagram, and Facebook. I'm on LinkedIn. Also, the Emerge website, www.emergefinance.com.au, has all our licensing details on it. But, guys, again, if you learned something, please pass it on. It's free. That's all I can ask you to do. And we'll see you all on the next episode. Thank you.
Thanks, man.
Thanks, man. Well done.